Hey, welcome to the 40 Finance channel. Shout out to all of my fellow bag holders out there. If your portfolio is filled with concrete bags, much like mine is that you see here on the screen, it's a tough time, right? And I'm heavily into the Nasdaq. And the Nasdaq and the FANG stocks, they've been hit very, very hard over this past week. So if you're in that situation, like me, and you might be thinking, gosh, when does it end? What sort of good news is there in this situation? And that's what this video is about. I'm going to give you a few scenarios, right, or a few categories of wins that my fellow bag holders and I can look forward to in the future. Now, as much as I say good news for bag holders like myself, I don't want you to get too excited because these are not things that are likely going to happen tomorrow. And in some cases, you have to do more portfolio management along the way. One is based around the market and sentiment, right? The next is around specific companies, how specific companies can change. We're going to use Google today in a lot of our examples. So if you're holding the bag on Google, what are some things that Google can do to change in the future to make those bags a little bit lighter? And the third category that we'll go through is more or less about you as an investor and what tactics you can do to dig out of this hole. Okay, so those are the three categories we're going to get into. Before we jump in, though, let's take a look at my bags. Let's take a look at my concrete bags of our portfolio so you can see at least what I'm dealing with. And the way this webcam is set up, I don't think you can see. Okay, there's the total value. So right now my portfolio in real time, thanks to Seeking Alpha, the portfolio's over at Ally Invest. It's 52,000. I believe that it's down over 50%, sort of on the scoreboard. That doesn't include dividends and sales and other things. I need to do a portfolio update. But for purposes of a bag holder video, let's just say the whole thing's down at least 50%. Now, as far as individual positions, I've got them sorted here by value, okay? And as I've talked a lot about, QQQ at the top, down 22%, cost basis of 352. PayPal, down almost 50%, might as well be 50%. Zillow, doesn't look like Zillow has anything promising coming out over the next year or so, as long as these interest rates do what they do. TQQQ, we talk about a lot. I'm down 50% on that one. DraftKings, minus 55%. Magnite, a total dud at minus 65. Rocket, minus 65. They're in the same boat as Zillow. Not a lot of positives going to happen there over the next 12 months, at least not that I can see. Palantir, minus 58. Square, minus 72. K-Web, Chinese Internet ETF, supposedly bought low on that one, and it got dinged again this week, minus 37%. And Sabre, minus 51%. So those are the bags that I'm dealing with right now. Now let's go into some of what I would say is the good news if you're in a situation like this. All right, now the first category has more to do with the broader market and the market conditions, right? The market is obviously chopped off across the board this year, and sentiment is very low. Most people are projecting a recession. Some people are projecting far worse than that. They're even projecting, financial collapse across the world. So that sentiment really weighs on the market, right? Because it keeps big buyers out of the market, at least those who buy into those theories. Now, the other big things that we have weighing on sentiment, at least here in 2022, obviously the Russian invasion, problems in China, both with COVID closures, and basically USA relations with China. That's weighed tremendously on the market. And then, of course, everybody's favorite, the Fed, and how they're hiking interest rates and becoming more restrictive on policy. So all of those things bring around negative sentiment when you compound them together. What we don't know, and what no one can really predict, is when some of those fears loosen up. right? Obviously, on the Russia side, there's no sign of it loosening up, but you never know what's going to happen. You never know what kind of treaties come into play, particularly with winter on the horizon. On the China side, we don't know if and when they'll change their COVID policies. And we certainly don't know if and when the United States and China will start playing nice with each other. Now, on the Fed side, there's, of course, two trains of thought there, but it might as well be a 50-50 bet. 2022 is pretty much a wash. They've already told us what they're going to do. What does 2023 look like? And how does market sentiment change if and when they either pause raising interest rates or perhaps flip the script a little bit for monetary and fiscal policy? And everybody who tries to predict the Fed, long term is almost always wrong because it changes as the economy changes, and what we think is going to happen very rarely does, okay? But bottom line, when you think about sentiment, and I just kind of brought up some sentiment headlines here, we're at a lower point, to say the least. Are we at the bottom? No idea, okay? And nobody does. But what I will say is that it's very negative right now, and it continues to get worse as these earnings reports come out, but eventually the sentiment will change. Now, that could be summer of next year, okay? It could be January 1st. We don't know, but as bag holders, we definitely need a shift in sentiment. It's figuring out when it's going to happen, that we'd all like to know. But at the end of the day, if you're a long-term investor, you just know that this is a negative cycle and some of that stuff will inevitably pass. Now, before we move on to the next category, which is how individual stocks and businesses can change, I do want to call out here, if you like the Seeking Alpha platform that I use here on the channel all the time, they're having an incredible sale right now, 1 year for $99. My affiliate link is in the description. So if you're looking for a stock research platform, you should definitely check out Seeking Alpha right now. I use it all the time. You do get like a 7-day free trial with that, potentially some more at my channel, which I appreciate. So again, link in the description, Seeking Alpha, $99 for 12 full months. Okay, so for this next section, we're going to talk about how an individual stock, how the outlook of that stock can change over time in a positive way. Okay, so if you're in Google, and I bring up the year-to-date chart, or excuse me, this is a 1-year chart, minus 35%. So if you're a bag holder in Google and you just got off of a mixed at best earnings report, you might be saying to yourself, hey, the future doesn't look very good over the next 3 to 6 months. I'm holding a bag here, minus 30%. What's the rationale for even staying in Google at this point? And I'll say right off the bat, there's definitely a mindset there between short-term investing and long-term investing. So if you're a long-term investor, you just have to ask yourself, quite honestly, did the company change? Did the outlook for the company change? Or are we just in a temporary economic setback? At least for me, my opinion with Google and being a QQQ stockholder, I feel really good that Google themselves remains a big part of where the world is going from a technology standpoint. But let's talk about what they could do in the short term that would potentially attract investor interest. And one of the things that you're going to see that Wall Street will celebrate all the time is any type of cost-cutting measure in an environment like this, okay? And when it comes to cuts at the corporate level, you have a few different ways to do it. Most people start with advertising and promotions and things like that. You also have employment cuts, right? So you have layoffs, you have hiring freezes. Ironically, in Google's case, they actually added more people in this past quarter, and when that showed up on the earnings report, obviously there's a lot of folks that questioned it. But the CEO went into it in detail, like, hey, we're going through this process, but what folks really want to see on the Wall Street side is they want to see the number of employees, the head count, go down, or at least the new additions fall dramatically. We have not seen that. So if you're a Google bag holder, this is one thing that I expect you will see over the next, maybe the next earnings report, certainly in the next 6 months, and that will be celebrated from a Wall Street standpoint. Now, in line with those cuts, and I just grabbed this headline here from a month and a half ago, you start breaking out, what is the core business and what are sort of investments, right? Investments, research and development, like how much of that stuff can we cut? And you can see even back in September, Google was making some changes to an experimental project group. And this is just a small example, right? So there's a lot of these R&D groups across the corporation that you can lay off and cut without even affecting the core business. And my guess is that Google and a lot of companies like them will begin trimming these areas, and that is good news if you're a bag holder. Okay, the next thing that can change for an international company like Google is the exchange rate. And the US dollar is very, very strong right now. And when you get into a company like Google that does a ton of international business, it really starts to eat at the bottom line. And if we look at this line where they sort of call this out, revenues grew 6% to 69 billion, short of 70.7. That revenue growth would have grown 11% in constant currency, CFO said. So these things like exchange rates don't always get talked about in the actual headlines that you see. You only just see, Google misses, it's doom and gloom, nothing's ever going to change. But if we go over here to their press release, which has all their numbers, and we start to think about how much international exposure Google has, which, international exposure for, depending on what day you wake up in the market, some people will say, well, that's good, right? You're just not condensed into the United States. You have growth in other countries, but now you're sort of in this situation where maybe it's best to just have a United States company because the dollar is so strong. It will not stay that way forever. That I can guarantee you. And we're in one of those times right now where it's costing international companies big dollars. So if we look here, this is a comparison from the quarter ended September 2021 to now. And we look at Europe revenues, and you can see that they are minus 2%. Okay, so that's Europe revenues. But if it was in constant currency, they would have grown 11% in Europe. That's not as good as the year before, where I think they were in the 30s or 40s on growth, but we know how the world has changed and people have gotten out more post-COVID. If you go to Asia Pacific, revenues, minus 2%. You do that on constant currency, though, it's plus 8%. This, by the way, if you add, let's just call it 20 billion and 11 billion, that's obviously $31 billion. You drop down the United States revenue is 33 billion. So international is a big to-do at Google, right? In the last category here, other Americas, you got 4 billion, which is up 12%. If it was constant currency, though, it would be plus 17%. So we don't know how long the strong dollar is going to last, and it has good news as well as bad news. If you're bag holding on an international company, just know that I would say it's unlikely for this to continue over the long haul. All right, so just to recap before we go on to the next category of good news for bag holders. The first category was broad market sentiment, broad market news, broad market momentum, right? Don't know when that's going to change. And then we just covered businesses, right? We used Google as an example. We talked about the potential for cuts, budget cuts, employment cuts, hiring freezes. All those things come into play. We talked about the strong dollar and how that literally cost Google billions of dollars. And when you really dug into the earnings report and you looked at it from a geographical perspective, you could see, how that really impacted the headline growth of revenues in each of those regions. The last thing to mention on the individual stock side, at least for bag holders, is you have the buyback factor, right? So companies like Google buy back shares all the time, they have the potential in this environment, when their stock goes below a price that they think is unfair, they have the potential to accelerate buybacks, which, that takes time, but in theory lowers the amount of shares outstanding and adds to your earnings. Apple's super famous for this. We'll see. Google, I know that they've done a lot of this in the past. I don't know in this economic environment how much more they're going to do, but buybacks is another way that an individual company or stock can turn around in this environment. All right, in this final category of good news for bag holders is how you can manage your portfolio. And one thing you're going to hear a ton about heading into December is the concept of tax loss harvesting, because whether or not people will admit it, most folks' portfolios are down this year. And you saw mine, so you know I have plenty of opportunity in tax loss harvesting, but I want to show you exactly how I'm looking at it, at least from my perspective. Now, the big thing you got to play with here is the numbers, and they're not big numbers. So for a guy like me as an individual investor with a portfolio that sank from 100,000 to 50,000, these numbers are fine. If you're a millionaire, they're not really going to make a dent in anything. But for the average Joe, you can go negative 3,000. So the limit of the write-off is $3,000 if you're married filing jointly, okay, which applies to me. It's $1,500 if you're just an individual. So when you're having a bag holding year like this, and if there's certain investments that you don't see a bright future for, you can try to get up to $3,000 credit on your tax return. I'm going to leave that statement as like a $3,000 write-off, okay? Because everybody's taxes are different. And I am not an accountant, financial advisor, none of those things. But in my personal situation, I am targeting the minus $3,000 for my tax return this year. So let's look at how I'm going to do that. All right, so this is a screenshot of my account from yesterday and the realized gains and losses. All right, so even though I'm holding major bags, I did manage to exit a few positions throughout the year for a positive, which has been good. All right, so let's look at those for a second. We had Amazon, Taiwan Semi, TJX, and Visa. I took those profits along the way, knowing that this year was going to be weird and it was very hard to tell which way it was going to go. They weren't big wins. If you add them all together, short term, long term, the whole nine, you get $4,300. So I'm up right now $4,300. And you better believe that with the bag holding portfolio, I am not going to be paying taxes on $4,300 at the end of the year. I can offset that by selling $4,300 worth of losses, right? Locked in realized losses. That would bring me a tax basis of 0. And I can also sell another $3,000, right? So I have the potential on where things stand today to sell $7,300 worth of losers in my portfolio if I believe that there's stuff in there that will never recover to the prices that I paid. And that is the key. So my opinion on tax loss harvesting is it's tricky because you really need to say that the stock has no future whatsoever, because once you sell it and lock in the losses, you've officially lost, right? So the bags get lighter, but the official L's are put on the scoreboard. All right, the next bit of good news for bag holders, if you take Google as an example, is just the pure dollar cost averaging approach to investing, right? And it's been proven time and time again, and here we are yet again learning this lesson over and over and over. So if you bought every day from 2017, I'm just using this 5-year chart, 11/17 through, let's just call it March of 2019, you had a few pivots in here where stuff went up and down. But the bottom line is you would have had Google for 50 some odd dollars in split adjusted terms, and you would be up to $94 today. On the 5-year chart, without doing the math on DCA averages, that's plus 85%, We don't know if Google's going to do that again. But what we do know is Google has an impressive track record for growing double-digit revenue and double-digit EPS over time. All of those stories have taken a step back, but if you DCA, if your cost basis is X and you're holding bags and you bring that down a little bit, then over time you're going to be rewarded with good companies that perform. And in my opinion, Google is one of those. All right, fellow bag holders, I just gave you a few reasons to have a positive outlook over the long term for your bag holder portfolio. Doesn't mean that all these stocks are going to turn around. Let's face it, there was a lot of speculative plays in 2020, 2021. But I would say the good companies, if you're holding bags on some of the top Nasdaq 100 stocks, I would say most of those have a better than not opportunity to bounce back over time. And from a portfolio management standpoint, it's hard not to get excited about some of this downturn if you are holding long term. You know, you hear it all the time about buy and hold, buy and hold. But when it really comes down to do that in the hardest times, which we're in right now, as there doesn't appear to be an easy exit anytime over the next 6 to 12 months, this is the time that a lot of people should be buying in and lowering their cost basis on good companies for the long haul. The unfortunate part, and I'm in this group, is that some of the things that we buy or some of the things that I've bought, I literally bought them at the peak, right? And so now if I still believe in what the company's doing, I need to chop off some of that cost basis. Good news is you don't have to do it all at once, right? You can DCA into this. So if you have a bag holding portfolio, maybe you identify 5 or 6 positions that you still believe in, and you just pepper in a couple shares every week or every month just to bring that down a little bit. And every time you buy a share, when you think about long-term capital gains taxes, you're starting that clock, right? So you got to wait a year to sell a stock under the lowest long-term capital tax rate. So when you buy a stock today, you're setting that clock for 1 year. And if the economy does take 2 years to turn around, well, by the time you get there and the trend goes up, you'll even be able to sell it at a better tax rate. All right, guys, before you go, check out that Seeking Alpha special offer. My affiliate link is in the description. Let me know if you have bag holder portfolio and what you're doing to manage it. Comments below, I always reply. Thanks so much for watching. We'll see you on the next video.